for what feels like forever, really. The UAE has had this reputation, hasn't it? The ultimate tax-free paradise for businesses, for investors.
Definitely. A place where corporate tax wasn't really even a conversation topic for many.
Exactly. Well, that whole landscape, it's fundamentally changed. We're talking about the introduction of federal corporate tax,
Right.
CT, and it's a big deal.
It really is.
So today, our deep dive is all about navigating this brand new world, specifically how it applies to what we call passive income for companies and investors.
Yeah, that's a key area.
And just so you know, this kicked in for financial years starting on or after June 1st, 2023, or January 1st, 2024, if your company runs on a calendar year.
And what's really interesting here, I think, is that this wasn't just some, random policy change, not a small tweak.
Right. It feels more strategic.
It absolutely is. If you connect it to the bigger picture, it's a very deliberate move by the UAE. It ties directly into their commitment to international tax transparency.
Aligning with global standards.
Precisely. Things like the OECD Pillar 2 rules. These are basically global efforts to make sure large multinational companies pay a minimum tax wherever they operate.
Okay.
For the really big players, global revenues over 750 million euros, this could even mean a 15% domestic minimum top-up tax.
Wow.
So it's a sophisticated balancing act. They want to boost the UAE's standing as a global hub, speed up economic development, stop harmful tax practices, but still keep a really competitive low tax rate overall.
Okay, so let's drill down into the core of today's deep dive then. Passive income under this new UAE corporate tax law. It's really important to get that this is different from your active trading income, right?
Yeah.
Your day-to-day business stuff.
Totally different, yeah.
The law points to four main types of passive income for companies. These are often the sort of quiet engines in your portfolio. First up, dividends.
Your share of the profits, basically.
Exactly. Distributed because you own shares. Second, capital gains. That's the profit you make when you sell shares or, other ownership stakes for more than you paid.
A classic passive return.
Third, interest. This covers payments you get for lending money or credit, and the definition seems quite broad.
It is. It includes things like discounts or premiums on debt instruments, essentially anything economically equivalent to interest.
Got it. And finally, royalties. Income from your intellectual property patents, copyrights, trademarks, getting paid for someone using your IP.
Right. Your innovation's paying off.
Now, here's a crucial point, I think. The UAE seems laser-focused on corporate tax here.
Absolutely.
So the law specifically excludes personal income, your salary from your job, interest on your personal bank account, income from real estate you own as an individual. That's all out.
That's correct. Completely outside the scope of this corporate tax legislation. It really targets the corporate sphere.
So our mission today is really to unpack the detailed conditions for exemptions, especially that really important participation exemption.
Perfect.
And also to really get the difference in tax treatment between companies in free zones versus those on the mainland.
Yeah, the distinction there is huge.
We're basically here to give you a shortcut to understanding all this, help you optimize your tax position, and maybe spot some strategic opportunities that are still definitely there. Okay, let's unpack this.
All right. So the UAE Corporate Tax Law brings in this really key provision. It's Article 23, the participation exemption.
Okay.
And its main job is to exclude income from what's called a participating interest from corporate tax. So what does that mean? It covers both dividends and capital gains.
Right. And the idea is to stop double taxation.
Exactly. It's about preventing profits being taxed multiple times as they move up a corporate chain. Mitigating economic double taxation. That's the core principle.
But it's not just automatic, is it? There are conditions you have to meet.
Oh, definitely not automatic. There are some pretty specific hurdles. First, generally, you need to hold at least 5% of the shares or capital in the subsidiary.
Okay, 5%.
And it's not just legal ownership. You also need what's called economic ownership. So being entitled to at least 5% of the profits and anything left if it's liquidated.
Or is there an alternative?
There is. If the amount you paid for your stake, the acquisition value, is over AED 4 million, that can qualify you too, even if it's less than 5%.
Okay. And what about how long you hold it?
Good point. There is a holding period. You need to have held the shares or, importantly, have a genuine intention to hold them for an uninterrupted 12 months at least.
So that stops people just flipping shares quickly.
Precisely. It's designed to separate real, long-term strategic investments from short-term speculation. And then here's where it gets quite technical, but really important.
Yeah.
The subject to tax test.
Okay, what's that?
This means the subsidiary The company you're invested in must itself be subject to corporate tax or something equivalent in its own country at a rate of 9% or more.
9%. That seems very specific.
It is. It's a strong anti-abuse measure. It stops companies using the exemption for investments in places with virtually no tax. It brings the UAE's rules in line with international anti-avoidance thinking.
Makes sense.
There's also another anti-avoidance rule. It's about asset composition. Basically, not more than 50% of the subsidiary's assets, direct or indirect, should be ownership interests that wouldn't have qualified for an exemption if the UAE company held them directly.
So it stops the subsidiary just being a shell holding non-qualifying stuff.
You got it. It ensures the exemption is for genuine operating subsidiaries, not just a parking spot for other assets that wouldn't get the break on their own.
That 9% subject to tax test, it does sound quite key. Could you maybe give a quick example, like a country or a situation where an investment just wouldn't meet that test, just to make it really clear for everyone listening?
Sure, great question. Let's say you invest in a subsidiary, and it's based in a jurisdiction that genuinely has, say, a 0% corporate tax rate, or maybe a very, very low rate. And that entity isn't subject to any kind of top-up tax anywhere else.
Okay.
In that case, that 9% subject to tax test, it wouldn't be met. So the participation exemption wouldn't apply, meaning the dividends or gains from that investment would likely be taxable back here in the UAE.
Crystal clear. Okay. And how does this all work for dividends and capital gains, depending on whether they're from inside the UAE or from abroad? Is there a difference?
Yes, a very important difference. Dividends you receive from another UAE resident juridical person, so another legal entity, like a company based right here. Those are unconditionally exempt from corporate tax.
Unconditionally, so none of those tests apply.
Correct. For domestic dividends, those conditions we just talked about, ownership percentage, holding period, subject to tax test, asset composition, they just don't apply. It massively simplifies setting up corporate groups within the UAE.
That's helpful.
However, for dividends and capital gains coming from foreign participation, so investments outside the UAE, all those conditions we discussed, the 5% or AED 4 meters, the 12 months, the crucial 9% subject to tax test, and the asset composition rule, they all have to be rigorously met for that income to be exempt.
Right. Much stricter for foreign income then.
Much stricter. And this detailed approach, especially that 9% test, really shows the UAE is serious about preventing tax avoidance and aligning with those global standards we mentioned. It helps solidify the UAE's image as a, legitimate and robust place for international holding structures.
Okay, so we've covered the special treatment, the exemptions for dividends and capital gains. But what about interest income? You mentioned it earlier. Here the rules seem to change quite a bit. It's a different landscape altogether, isn't it? There's no similar broad exemption for corporate interest income.
That's spot on. Yeah, completely different. Unlike that wide-ranging participation exemption for dividends and gains, interest income for corporations is generally just part of the company's taxable income.
So subject to the standard CT rates.
Exactly. Subject to the standard rates. When the law talks about interest, it's mostly focused on the deductibility of interest expenses, like how much interest costs you can subtract from your profits.
Ah, so an expense issue rather than an income exemption issue.
Primarily, yes. And applying anti-abuse rules around that, it's not really about exempting the interest income itself for corporations.
But you mentioned individuals earlier.
Right. And it's really important to stress this again. Interest and other income earned by an individual, a person from their personal bank deposits or saving schemes, are explicitly exempt from CT. That's purely for personal savings and investments.
Okay. Personal good, corporate, generally taxed. Any other wrinkles?
Well, there's a point about qualifying infrastructure projects. For those, the net interest expenditure might not be subject to certain deduction limits. That can indirectly make the environment a bit more favorable for any associated interest income, but it's quite specific.
So the fact there isn't a general corporate interest income exemption, that seems like a very deliberate policy choice, drawing a clear line between interest and dividends or capital gains.
Oh, absolutely deliberate. It signals that the UAE intends to tax active financial income earned by companies. But at the same time, they want to stop companies deducting excessive amounts of interest, which could eat away at the tax base.
Right, protecting the tax revenue.
Exactly. The detailed rules they have around how much interest you can deduct, including things like a general interest deduction limitation rule, really underline that objective. It's a sophisticated way to regulate financial transactions, keeping the UAE attractive for investment, sure, but also maintaining a solid tax base.
Okay, let's switch gears again. Royalties. because this is another area where potentially a significant tax exemption can come into play, especially if you're set up in a free zone.
Indeed, yes. Income that you get from intellectual property that you legally own, think patents, copyrights, certain types of software that can qualify for a 100% tax exemption, 0% tax.
Wow, 100%.
That's powerful.
It's a very powerful incentive, clearly designed to encourage innovation and attract businesses that hold significant IP assets.
But there are conditions, I assume.
Of course.
Yeah.
To get this benefit, the IP has to be qualifying intellectual property. Generally, that means patents and copyrighted software. But importantly, it specifically excludes marketing-related IP. So things like trademarks don't qualify for this. Okay, so patents and software, but not brands.
Broadly, yes. And crucially, this preferential 0% rate for IP income is primarily aimed at what the law calls a qualifying free zone person.
So it's very much tied into having that free zone status again.
Very much so.
And I remember reading something about a direct link needed, a nexus, they call it, between the IP income and the spending the free zone company does. What does that actually mean for a business on the ground?
Precisely. This nexus requirement means you need a clear, direct connection, almost like drawing a straight line between the income you earn from that qualifying IP and the specific costs you incurred to develop or maintain it.
So R&D costs.
Typically, yes. Direct R&D costs like salaries for your researchers, your engineers, the cost of materials they use. It's not enough just to own the IP passively in the free zone. You have to demonstrate you're doing the real work there that generated or maintains that IP.
Substance again.
Substance is key. The entity also has to maintain adequate economic substance in the free zone itself. And like we said before, this isn't just a mailbox.
Right. Real operations.
Real operations, actual employees working from a physical office, genuine business activity happening in that free zone. They also need to make sure any transactions with related parties are done at arm's length.
Market rates.
Market rates, exactly, as if dealing with a completely separate company. And then there's a really critical rule. The de minimis requirement.
De minimis. Okay, what's that threshold?
Non-qualifying income, which includes non-qualifying royalty income, must not exceed 5% of the entity's total revenue, or AED 5 million, whichever amount is lower.
5% or 5 million AED, whichever is lower. That sounds quite strict.
It is very strict. Think of it as a very small allowance for other income. If you go over this limit, you risk losing the 0% rate on all your income, not just the bit that went over.
Wow, okay, so that's a major cliff edge.
It really is. And naturally, keeping absolutely perfect records is non-negotiable. This whole structure, it's a very sophisticated strategic move by the UAE. It targets those high-value, innovation-focused sectors, aligns with international best practice for these IP box regimes, and makes sure the tax benefit is genuinely linked to economic activity happening within the UAE.
This brings us perfectly to that really crucial distinction, the one that sort of defines the UAE's competitive strategy now. How the rules are radically different if you're operating inside a free zone versus being on the mainland. It's a cornerstone, isn't it?
Absolutely. It's fundamental to understanding the new system. Free zones were set up specifically to draw in foreign investment with attractive perks.
And that continues under CT.
It does, but with conditions. Qualifying free zone persons, or QFCPs as they're known, can still benefit from a 0% corporate tax rate, but only on their qualifying income.
And what counts as qualifying income?
Primarily, it's income from transactions with other businesses located in free zones, or with businesses located outside the UAE entirely. International trade and services, essentially.
And does that include passive income?
Yes, it can include passive income like dividends, capital gains, interest, and royalties, but crucially, they generally need to originate from legitimate international activities or meet other specific free zone conditions and regulations.
So for our listeners who might be in a free zone or thinking about it, what are the absolute key things they need to do to keep that 0% rate? What's the biggest trap they need to avoid?
Okay, the conditions are definitely stringent. It's easy to trip up. First, as we've touched on, adequate economic substance. That's paramount.
Real operations, physical presence.
Exactly. Staff, resources, demonstrable activity. If you don't comply with the economic substance regulations, you can lose the status. Second, your income has to come from qualifying activities as defined in the legislation. Then there's that critical de minimis rule we just discussed for IP. It applies more broadly, too. This is probably the biggest pitfall.
The 5% or 5 million AED limit.
That's the one. If your income from the mainland, and this generally excludes purely passive income from the mainland or income from certain excluded activities, goes over 5% of your total revenue, or AED 5 million, whichever is lower.
And what happens?
The entity risks losing the 0% tax rate on all its income for potentially 5 years. Not just the non-qualifying part, all of it.
That's incredibly harsh. A real game of purity, like you said.
It is. Even a small amount of the wrong kind of income can trigger this full tax scenario, wiping out the entire 0% benefit. QFCPs also generally need audited financial statements, and they must not choose to be subject to the standard 9% CT regime. If you opt into the 9%, that decision is permanent. You can't go back.
What if a free zone company actually operates a physical branch on the mainland? Does that automatically disqualify it?
Not automatically, but it definitely complicates things. If a free zone entity has a proper mainland branch, the income generated by that branch will be subject to the regular 9% corporate tax rate.
Okay, so the branch income is taxed, but the free zone income?
The free zone entity can still keep the 0% rate on its qualifying free zone income, provided, and this is crucial, it keeps separate, meticulous books of account for the mainland operations versus the free zone operations.
Segregation is key.
Absolutely key. Fail to keep those books perfectly separate, and all your income, free zone included, gets taxed at 9%. It's a very clear line they've drawn.
And what about the scenario where a free zone entity deals with the mainland, maybe sells goods or services there, but doesn't have a physical branch? This seems like a really critical point that could catch businesses out.
It absolutely is critical. And yes, it could catch people out. A QFCP can still get the 0% CT rate on certain income derived from the mainland, but only if that income is strictly limited to purely passive income.
Passive only. So what does that cover again in this context?
We're talking only interest, royalties, dividends, and capital gains that come from owning shares in mainland UAE companies. Purely investment-type returns from the mainland.
And if they earned any other type of income from the mainland, like active trading income?
Any other non-passive income sourced from the mainland, say, actively selling services or goods to mainland customers without it falling under specific distribution rules, will completely disqualify the free zone person from the 0% CT regime.
For everything, including their free zone income?
Yes, for all their income, including their otherwise qualifying free zone income. It's a severe consequence. The aim is to stop free zone companies having an unfair advantage over mainland businesses doing the same thing, and to keep the free zone benefits focused on their intended purpose, international trade, and specific activities.
Right. So think of it like this. Free zones are for international business and certain passive activities. If you step outside that into general active trading on the mainland, the special tax deal vanishes. For everything.
That's a very good way to put it. The preferential treatment evaporates.
So turning to mainland companies then, for them, it's generally the standard 9% treatment we discussed.
Yes, exactly. Mainland companies, and also foreign companies that set up what's called a permanent establishment here, they generally fall under the standard UAE corporate tax rates.
Which are?
It's 0% tax on taxable income up to AED 375,000, and the 9% on any taxable income that exceeds that threshold.
And for their passive income, how is that treated?
Generally, passive income like interest, royalties, dividends, capital gains, it's just included in their total taxable income, unless, of course, a specific exemption applies.
And the main exemption we've talked about is?
The participation exemption. That's the big one for qualifying dividends and capital gains from subsidiaries. And remember, dividends received from other UAE companies are unconditionally exempt anyway for mainland companies, too.
Right, but interest income for a mainland company?
Generally taxable. The focus there, as we said, is more on the rules around deducting interest expense.
And royalties for mainland companies?
Also generally taxable at the standard rates.
Yeah.
They don't get that broad 0% benefit for qualifying IP that free zone entities might get, unless perhaps under very specific narrow conditions which are less common.
So it really highlights that dual strategy the UAE has.
Mm-hmm.
Free zones geared towards specific international activities and innovation hubs, maybe, and the mainland for the broader domestic economy and general commercial activities.
Precisely. A dual-pronged economic strategy clearly reflected in the tax system.
It definitely sounds like keeping that exemption status, whether it's the participation exemption or the free zone 0% rate, isn't just about ticking boxes once. It requires ongoing effort and vigilance.
Yeah.
What are the biggest risks of losing that status after you've already qualified?
You've hit on a really crucial point there. It's absolutely not a set it and forget it situation. The Federal Tax Authority, the FTA, has teeth. They have what are called General Anti-Abuse Rules, or GAR.
GAR.
This means they can basically ignore an arrangement and deny any tax benefits if they believe the main purpose of setting it up was just to get a corporate tax advantage that goes against the spirit of the law, especially if there's no valid commercial reason behind it.
And what's a major red flag for them? Something that might trigger GAR.
A critical trigger, as we've mentioned a few times, is that lack of economic substance. If an entity, particularly one in a free zone claiming 0%, doesn't demonstrate real operations, doesn't have an adequate physical presence, doesn't have enough qualified staff doing the work, it's at very high risk of losing that preferential treatment.
So substance isn't just a setup requirement, it's ongoing.
Absolutely ongoing. And this fits perfectly with global efforts against, letterbox companies or arrangements with no real economic activity behind them.
So it's not just these general anti-abuse rules, but also failing to meet the very specific conditions for each exemption continuously. Can you maybe walk us through a couple of practical ways a company might accidentally lose its exemption for, say, dividends or for its free zone status?
Sure. Let's take the participation exemption for dividends and gains. If your ownership percentage drops below that 5% threshold, or maybe you sell the shares before the 12-month holding period is up, the exemption is lost for that income.
Oh.
Or, critically, if the foreign subsidiary you invested in stops meeting that 9% subjected tax test, maybe their country lowers its tax rate, the exemption on future income from them could be lost. Same if the subsidiary's assets change significantly and more than 50% become non-qualifying assets. That asset composition test is continuous too.
Right. And for the free zone 0% rate.
The big one there is breaching that de minimis rule for non-qualifying income, especially non-passive mainland income. If that income creeps above 5% of total revenue, or AED 5 million, boom, you could lose the 0% rate on all income, qualifying or not, like we said.
That seems like the easiest trap to fall into if you're not watching carefully.
It really does require careful monitoring. And for free zone entities that do have a mainland branch, failing to keep those separate books of account we talked about, that's another way all income gets taxed at 9%. Total segregation is vital.
And for those royalty exemptions on qualifying IP.
If you can't clearly demonstrate that ongoing nexus, that link between the royalty income and your qualifying R&D spending in the free zone, or if your documentation just isn't up to scratch when the FTA asks, that exemption is definitely at risk. The FTA has the power to deny these benefits even if you've paid taxes somewhere else. So being proactive, being compliant, and keeping meticulous records isn't just good practice, it's absolutely essential.
Okay, so given all these changes, all these nuances, what are the key tax planning tips for holding companies, for investors? How can they still leverage the clear advantages the UAE offers?
Well, first and foremost, actively leveraging the participation exemption is crucial. If you're setting up a holding company, structure your investments deliberately to meet that 5% ownership and the 12-month holding period. This still makes the UAE incredibly attractive for international investment platforms.
And checking that 9% rule for foreign investments.
Absolutely. Before investing in a foreign subsidiary, always verify that it's subject to a corporate tax rate of 9% or more in its home country. And don't forget to capitalize on the unconditional exemption for dividends coming from other UAE resident companies. That allows for super efficient profit movement within domestic groups.
And when it comes to optimizing free zone structures, especially for passive income, what should listeners really keep top of mind? Is there a golden rule?
I think the golden rule is maintaining that qualifying free zone person status through genuine, tangible actions. It's not just paperwork.
So choosing the right zone.
Yes, choose the free zone that actually aligns with your business strategy. Then, strictly adhere to those adequate economic substance requirements we keep mentioning. Real physical presence, real staff, real expenses happening there.
And managing mainland income.
For free zone entities without a mainland branch, make absolutely certain that any income derived from the mainland is strictly passive interest, royalties, dividends, qualifying capital gains. Nothing else, typically.
Monitor that de minimis threshold like a hawk.
Exactly. Diligently monitor it to avoid that catastrophic pitfall of losing the 0% rate on all your qualifying income. And if you do have a mainland branch, always maintain entirely separate books to ring-fence your free zone income at 0%. The ability for free zone entities to get 0% on qualifying passive income, particularly acting as holding companies, still offers really significant flexibility and tax advantages if managed correctly.
Are there other tools in the toolbox?
Definitely. Don't forget the UAE's massive network of double taxation avoidance agreements, over 140 treaties now, I believe.
Right. How do they help specifically?
They can provide reduced, sometimes even zero, withholding tax rates on things like dividends, interest, and royalties flowing between the UAE and the treaty partner country. That seriously improves cross-border tax efficiency. Plus, they provide certainty on tax residency status.
And the UAE itself doesn't levy withholding tax.
That's another standout advantage. The UAE currently has zero withholding tax on domestic and cross-border payments like dividends, interest, royalties, which is a huge draw for international structures.
Okay, so if we were to summarize the absolute best practices for compliance and managing risk in this new environment, it sounds like meticulous record keeping is number one.
Non-negotiable.
Ensuring clear, demonstrable economic substance.
Title.
Adhering strictly to transfer pricing rules for related party transactions.
For arm's length always.
Conducting regular tax health checks to make sure you're still compliant.
Very wise. Proactive reviews.
And probably engaging professional advisors when things get complex or if you're in doubt.
Absolutely. Don't guess. The rules are detailed.
It really seems the core message is the benefits, the advantages of the UAE, they're definitely still there. But you have to actively work to secure them and maintain them. You need to understand the rules deeply.
That sums it up perfectly. The landscape has changed, but the opportunities remain for those who navigate it correctly.
So maybe one final thought to leave our listeners with.
Well, if we just connect this back to the bigger picture one last time. The UAE's really bold move here, integrating more fully into the global tax system while, fiercely trying to protect its competitive edge, it really does set a precedent. And it raises an interesting question for you, the listener, to think about. As global economies keep moving towards more standardized tax rules, how might this really sophisticated balancing act by the UAE influence what other countries do? And what does it tell us about the future, maybe, of international financial centers in general?